All right, here we go. We're live on Facebook. And welcome, everybody. Welcome to this week's episode of the Ecom Sales Tax Podcast. I'm Andy Johnson. I'm here with my co-host, Daniel Peisner, CMI. Hey, Dan.
Hey there, Andy.
How's it going this week?
It's going well. We've got some nice weather for a change.
Yeah, I was noticing that. A little bit of sunshine in the background there as opposed to the constant thunderstorms.
Well, this is Texas, so just wait a day and they'll be back.
Apparently they will. All right, Dan. Well, this week I thought it would be good to talk about e-commerce businesses, hence, the name of the Ecom Sales Tax Podcast. But one specific issue, and that is companies who sell items probably for resale. That's probably the most common exemption. If they're selling to other businesses, they may be selling to distributors. Now, there's other types of exempt customers. Maybe it's a hospital or a church or a school or something along those lines. But I thought it would be good to talk about just some issues around this whole area of e-commerce businesses and what they should be doing about certificates. So Dan, just give us a little bit of background, a little bit of context. What are the general rules if you're selling tangible property and your customer says, hey, don't charge me tax, I'm exempt?
Well, once you are registered to collect the tax within a state, you are required to collect tax on all of the transactions that take place within that state, unless it's some form of product that is on its face exempt, or unless your customer supplies a valid exemption certificate. And as you said, Andy, the most common form of this is the humble resale certificate. And what this will simply say is that your customer is purchasing it to resell in the ordinary course of business. They have to provide their taxpayer ID number for that given state. Usually they may have to check and fill in a few other items, and then they will sign it, present it to you, and then you are essentially off the hook for collecting tax on that very transaction.
So sometimes tax nerds like us, we get all caught up in the technicalities, and let's talk about the real world practical impact of exemption certificate management or lack thereof. So for example, I'm just going to share a slide in case people are watching. Just adds a little bit of interest. One thing that I say a lot of times in teaching people about fighting sales tax audits, and this is the practical world. The real world of exemption certificates is they don't do anything for you except give you a good feeling maybe until you're audited. If you were never audited, then certificates do nothing. There's no value that they add except they take up space in your filing cabinet or on your hard drive. So there's nothing of value to them unless you dispute that, Dan, until you are audited. Because the general rule, like Dan said, is if you make a sale of taxable goods in a state where you have nexus, then you must collect the tax on those goods or collect a valid certificate in lieu of the tax. There's just, an on-off switch right there that you have to collect that. If you fail to collect the certificate, then you very well may be selling something for resale. It's not like a moral transgression, right? Because the theory of sales tax is it should be applied to the ultimate consumer, right? So it's not like you're being dishonest per se. It's just you don't have the document. But what happens is when you get audited, then the auditor says, if you can't prove to me that this item is for resale, for example, then I have to assess the tax. And that's when the auditors get all technical because it's just too easy, right? If you don't have just the right form with the right signature and the right date filled out correctly, then they just say, well, sorry, it's not documented correctly, therefore I must assess the tax. I have no choice. That's the position that auditors always take. And I always say it's very easy for an auditor to find this problem. It falls in that category of very little work, big reward. And so when an auditor comes in and says to an e-commerce business and says to them, let's say it's an auditor for the state of Texas. Texas is very active in the sales tax audit world, and they're very rough on certificates. So they come and audit you, and very businesslike, they'll just be very friendly. Texans are always friendly. And they'll say, hey, part of my responsibility is just to double check your sales figures. And if you would, go back into your records and produce for me a report of everything that you didn't collect tax on. I won't make you do it for the whole period. That would be way too much work. Let's just pick a month, and the whole audit period's 4 years. Let's go back to, say, April 2015. And if you could, just produce a report. All right, so you e-commerce businesses, think about that. If a state like Texas came to you and said, I need a report from 2015 April of every transaction that you shipped a good to the state of Texas on which you collected no sales tax, how easy would it be for you even to produce that report? And we haven't even got to the bad part yet, right? What I have found in my many years of experiences, it's not unusual for companies not to have to be able to pull a report like that, because it involves ship to information. And a lot of companies don't necessarily maintain a report like that based on ship to locations. But that's the report that they want, or that's the report that you should give to them. They may want a lot more. But anyway, so they look at that. You finally pull together a report. It was a lot of work. You had to work weekends to do it. You finally get the report, then you give it back to the auditor, or your representative gives it back to the auditor. Basically, what the auditor does at that point is say, maybe they'll upload it into their own software, but pretty much what they do, very little work. They just say, here's this report right back at you, and now all I need from you is on each one of these transactions, I need the certificate that you collected, the exempt certificate that you collected at the time of that transaction. So just produce that for me. Take your time, get it to me in a couple of weeks, and I'll review those. And if everything's fine, then we're in good shape. So Dan, thinking about all the projects you've worked on, how likely is it that going back 3 to 4 years, an e-commerce business will have 100% of its exempt certificates from April of 2015?
I would say it's pretty rare. I don't know if it's, I wouldn't necessarily say Cubs winning the World Series rare, but it is a rare phenomenon. What we typically find with a lot of our clients is that when they get asked to produce those on audit, that you've got a lot of them that are missing, you've got a lot of them that are incomplete. The seller's name and address is not filled out. The buyer's name and address may not be filled out. We've got a lot of them. You see a lot of them that just put in that sent the wrong certificate, where they sent a tax permit in a state where that's not. There are a couple of states out there where that is the appropriate form, but it's very rare. Some, for whatever reason, decided to send a W-9. I still don't understand why that ends up in the exemption certificate file.
Hey, whatever form gets the tax off my invoice, that's what form I'm sending in. Well,
they send it in, they do. So you get all those forms, you hand them to the auditor, and the auditor ends up rejecting a bunch of them. Right. As you said, it's low-hanging fruit. Almost every state out there has a regulation or a statute that says that a properly completed certificate must be issued. And they can point to it and say, this is what our rule says. You didn't fill in, or they didn't fill in the seller's name and address. especially if you're selling to a particularly big company, like say you're selling to you're doing drop shipping for Wayfair, or you're doing drop shipping for for Best Buy, or for one of these big companies. A lot of them just send out, they're so overwhelmed, they send out certificates halfway filled out, and they don't fill them in. That's not to say that every auditor is going to disallow them. I've seen some auditors that have surprised me. I gave them a certificate. I said, there is no way this is going to pass muster. They accepted it. So there really is no universal constant for it. But I've at the same token, I've seen some very aggressive auditors that just disallowed anything. They even disallowed valid ones. We had to go back and fight. But all the incomplete ones all just got tossed out, and auditors set all those sales right up, and that added up quite a bit.
Yep. Yeah, that's definitely true. To me, as I've worked on these myself so many times, it wouldn't be unusual for an auditor to find 20 to 50% of, first of all, for the company to go back and say, wow, I'm missing 30% of the certificates. I'm just 30% of these transactions I just don't have. And then they give their 70% of their certificates, and it contains all those things you talked about, Dan, with W-9s and all these types of things, or they're just not dated correctly or signed, and it's the wrong form, and the auditor disallows another 20%. So that's why I say it's such low-hanging fruit, because the auditor says, hey, 50% of my 1 month sample is not valid. So what that means is half of the population of sales on which you collected no sales tax in my state, you should have collected sales tax. And so whatever think of if you're an e-commerce seller and there's transactions that you didn't collect sales tax on, that 50% of them would be taxable. So that times 8% times 50% times 1.5 for penalty and interest. And you could see how this really could add up. Dan, let's talk about the extrapolation methods, because it's not unusual for a state auditor to say, I'll pick 1 month from each of the years under audit, and then I'll extrapolate from there. So if it's a four-year statute like in Texas, then 1 month into 48, that means, or 4 months into 48, that means whatever they find times 12, right?
Yeah. Some states will do the block sampling method, similar to what you've just mentioned. Some of them will do, instead of a dollar stratified, where they'll pull, say, 100 or 200 transactions, and they will look at they'll look at them, and everything that doesn't have tax on it, they're going to want a certificate for. So you can have certificates for for a lot of your vendors, but if it's not the one that ends up in a sample, then it's not going to help you much. You've got to have and you never know what's going to end up in these extrapolated audits. So you've got to try to get a certificate on everything. On another note, you want to make sure you get those certificates timely at the time of sale. There are a lot of states that say you need to get it within 90 days of the sale.
So Dan, I'm really glad you brought that up, because when you look at the statutes across the different states, there are a number of them that say the only valid certificate is a certificate you got at the time of the transaction, which seems incredibly harsh to me. And I would just point out that in my experience, even though the statute may say that, in my experience, every state that we've ever come up, knock on wood, has allowed us after the fact to get certificates. Let's talk about Texas specifically. How does Texas, what's their timeline like? If you're under audit by the state of Texas and they find missing certificates, what does that process look like? What's the limitations there?
The limitation is if they ask for certificates, then if they do the audit, they find a bunch of certificates missing, they send you the bill. You come back and say, no, wait a minute, these are resale, I can get them. You file a timely appeal, That opens the audit back up, sends it back to the audit office. You are then given a letter that says you have 60 days in which to produce those missing certificates. Any certificates that are issued after that point are not valid. They cannot be produced in you can't produce them in a hearing later. I don't even think you can produce them if you take it to district court, because statutorily, once they issue that letter, you have to provide the certificate, and that is a hard and fast rule. One of the other disadvantages to waiting and producing the certificates after the fact is like the 90-day rule in Texas, and even in Texas, even if they do accept it, they will provide, they can do additional scrutiny. When you accept that certificate at the time of sale, before that audit starts, you're given in many states what's known as good faith. Means you don't have to go hire a private detective. You don't have to launch a forensics investigation. You can just, as long as it's not something painfully obvious, like a widget retailer buying some office furniture they claim is for resale, as long as it seems reasonable and it's with regular course of business, you don't have to do a deep investigation. You can accept it. It's on them. When you provide it later, you don't get good faith. You get the auditor trying to dig deeper. This includes everything up to, and I've seen this, them calling the issuer of the certificate and badgering them to get information as to whether or not it was really used whether they really resold that or it was used for an exempt purpose. Let me tell you, your customers absolutely love it when the comptroller's calling them 3 times off the hook, trying to talk to them.
Right. I think that's one of the reasons, I'm sure it is, that the initial sample is always like 3 years ago, because it's the chances of losing it over that time period. But even if every state gives you some window of time to get the certificates, if you're looking for certificates that are 3 or 4 years old, the chance of getting them from your customers drops, right, precipitously. And you were telling me, Dan, that you're working on an audit right now where you're trying to get an exempt certificate from a client. And what's his hesitation?
Well, the hesitation is that the business was sold, and so this is the new company, or the new owner that would have to sign off on this. And so he's looking at the certificate and saying, "Now, I don't know what happened on here. Is this really valid? Do I want to put my name on this?" So the longer out those audits go, the bigger a risk that becomes. Sometimes you just get a good old-fashioned bankruptcy in there, and there is nobody left to sign a certificate. Yeah,
or they've been acquired by somebody. It could be that the customer in question is, wholesaler Inc., right? It's clear that the item is for resale. Yet I've seen cases where the customer in question is Walmart. The auditor still said, "No, I don't have a certificate from them." So you're obviously, it's clear you're selling products that Walmart is reselling, but the auditor won't accept it without the certificate. Now, Walmart, you should be able to get the certificate, assuming you can talk to the right person. But what's the moral to the story, Dan? What's the bottom line of all this?
The bottom line is, if they do not give you a certificate at the time of sale, charge them the tax. And a note for those of you that are, and those of you out there that are looking at the oncoming economic nexus, when we talk about resale certificates, there's a number of multi-state forms out there. The Streamlined Sales Tax Project has one for all the streamlined states. Multi-State Tax Commission puts one out that's accepted in a pretty decent number of states. You got to be careful and make sure those are the most current versions. But you can get a lot of, especially at least for resale, you can get a lot of resale numbers all at once. And it's good to, typically a lot of the big sellers will put every one of their permit numbers on them, because they don't want to have to reissue it later. And even though you may not have nexus in that state today, tomorrow you might, or you might in the next month or 3 months, especially at the rate these states are starting to adopt economic nexus. Do you really want to be rehashing this and asking them for another certificate in 3 to 6 months?
So it's just easier. It adds a little bit of friction to the transaction to request a certificate, but it just needs to be, for your protection, part of your process. And best practice usually is, if they don't supply this, bill the tax until you get the certificate. Yeah, you eventually have to go back and refund the tax when you get the certificate, but you got to keep your leverage, or else you may never get the certificate, and you end up having to pay that tax out of pocket yourself that you should have collected from your customer, or they should have paid you. So thank you so much, Dan. Thank you for sharing your expertise. That concludes this episode of the Ecom Sales Tax Podcast. We'll see you next week.
My pleasure, Andy. Thank you.